right into your mind. Deja vu, I just been in this place before. Higher on the street, and I know it's my time to go. Calling you, and the search is a mystery. Standing on my feet, it's so hard when I try to be me. Whoa, deja vu, I just been in this time before. Higher on the beat, and I know it's a place to go. Calling you, and the search is a mystery. Standing on my feet, it's so hard when I try to be me. Yeah.
I'm convinced I have this special ability where I can time the market to absolute perfection. It's like I can manipulate all the powers of the universe and make them revolve around me. This is a secret, so don't tell anyone else. But when I buy, it dips, and when I sell, it moons. Maybe I should start a trading signals group, what do you think? Recently, I've been making a couple of $100s a day trading crypto, so I thought I'd share my experience. But before you start trading anything, I found that there are 3 essential things you must understand before you begin your trading journey.
Understanding candlesticks and their meaning is a must-have in your TA arsenal. Basically, they show the high, low, open and closing prices of a security for a specific period. Green candlesticks indicate there is buying pressure and the price is bullish. And red candlesticks indicate there is selling pressure and price is bearish. Now, candlesticks should be looked at in the context of the market structure as opposed to individually. A single arrow is easily broken, but not 10 in a bundle. Understanding candlesticks and chart patterns is a total game changer because they factor in one thing that a fundamental analysis can never visually represent, and that is the emotional sentiment of the market at any point in time. By using candlesticks to make trading decisions based on patterns, you can draw insights and signals that will help you forecast the direction of prices. Investors' emotions surrounding the trading of an asset have a major impact on the asset's movement, and candlesticks help traders gauge emotions, which helps them make better predictions about where the stock or asset might be headed. For example, a hammer candle indicates a potential price reversal, where the bulls have pushed prices up after overpowering the bears, represented by the long tail of the wick. I find that hammers are most effective when preceded by 3 or more declining candles. When you look at engulfing patterns, they form when a small candlestick is followed by a large candlestick, which completely engulfs the body of the previous candlestick. They can be either bullish or bearish depending on the engulfed candlestick. Over here, it would be considered bullish since the green candlestick engulfs the red smaller candlestick. And again, you need to look at a few of the preceding candlesticks instead of looking at the engulfing pattern in isolation. I find that candlesticks are most useful when following clean price movements, as patterns clearly show the shift in momentum to either the upside or downside. If the price action is choppy and there's mostly just a lateral price action, the significance of patterns greatly diminishes.
There are a lot of other candle patterns, so I recommend for you to read Japanese Candlestick Charting Techniques by Steve Nissen, because it will provide you a more thorough understanding of how they are used.
Trading indicators are another very powerful tool you need to utilize in order to become a successful trader. The first rule of using trading indicators is that you should never use an indicator by itself or too many at once. Just focus on a few that are best suited to what you're trading and experiment to see whether it works or not. Remember that indicators only tell you a probable outcome. They should be used alongside your own assessment of price movements. There's a bunch of them like Bollinger Bands, EMA, Ichimoku Clouds and VWAP, and they're all very effective in their own way. You can use your own knowledge to decide which of these trading indicators best suit your strategy. I personally use MACD as an oscillating indicator to detect changes in momentum. It does this by comparing 2 moving averages, which helps me identify possible buy and sell opportunities around support and resistance levels. If the moving averages are converging, it means momentum is decreasing. Whereas if the moving averages are diverging, it means momentum is increasing. The histogram in yellow graphs the distance between the MACD and signal line, so you can identify when it crosses the baseline. When the two MAs cross, visually represented by the histogram at the zero baseline, it's a signal to buy when MACD crosses above the signal line, and sell when the MACD crosses below the signal line. I also use the RSI, which evaluates overbought or oversold conditions. It differs to the MACD as it measures the price change in relation to price highs and lows, whereas MACD measures the relationship between two EMAs. Again, I would avoid trading when an asset moves sideways because it often produces a false positive. It's also important to remember you have to confirm a signal before you enter a position. If you're getting a buy signal from an indicator and a sell signal from price action, you need to use different indicators or different time frames until your signals are confirmed. When you align these areas of confluence, you're adding caution to caution, and your trades are more likely to be successful.
So using indicators really simplifies price information, in addition to providing signals and warnings about price movements and reversals. But both candlesticks and indicators will be pointless without the last concept, and that's trading psychology. How do you know when to enter a trade and when to take profit?
It all comes down to support and resistance levels and the game theory behind these critical levels. Remember, the trend is your friend. When you look at behavioral finance, it analyzes the emotions and mental states. Fear, greed, hope, and regret are the most common emotions that drive trading behavior. It often clouds rationality and judgment even when your intuition is telling you otherwise.
Do you know what's the single most important thing tied to a trader after they enter a trade? It's their entry price. People have a connection to the price which they entered at, and most of the time, it can act as a mental block to take profits or cut losses, regardless of what the market movements are telling you. Another thing to look out for is a psychological barrier around full round numbers, such as $1, $50, or $100. Oftentimes, these can act as support or resistance areas because everyone else has their limit orders and stop losses there. So if you want that to trigger, you'd set your buy and sell just before it. For example, you'd set a limit order at 95 cents instead of $1 because this is an inflection point where some type of price action is expected, either a reversal or a break. There are numerous instances where a trader must rely not only on the chart's insights, but also their own knowledge of the security they're following and how broader factors are affecting the market, such as when you buy and Bogdanov goes, dump it.
Bogdanov, he did it.
Il bought,
He went all in.
dump it.
Trading is hard. No, it's very hard. There's a reason why 95% of traders lose money. Take your time to learn the art, have risk management, do your TA, and execute your own trades. With enough time and discipline, you'll be able to read charts like a book. Just in case you were wondering whether I sold during the dip. You see these hands? They're diamond hands. See you guys at the moon.